Hello, this is Ashley McHugh from Insurance Newsnet, and I will be the administrator for today's webinar, Can Life Insurance Rescue Your Client's Retirement? Moderating the webinar is John Hilton, Senior Editor at Insurance Newsnet. John has been with INN since 2015, following a long career in newspapers. Our panel today includes Jennifer Tornadin of Legal & General, Guy Baker of Wealth Teams Alliance, and Michael Fontanini of Lion Street. Jennifer is Senior Vice President, Distribution, Marketing, and Strategic Growth of Legal & General America's Insurance Division, which includes Banner Life Insurance Company and William Penn Life Insurance Company of New York. Jennifer is responsible for growth initiatives across the entire organization. Guy is the founder of Irvine, California-based Wealth Teams Alliance. He is a member of the Forbes 250 Top Financial Security Professionals list and author of The Great Wealth Erosion and other books. He received the 2019 John Newton Russell Memorial Award for Lifetime Achievement in the insurance industry. Michael is Vice President, Advanced Planning and Design with Lion Street Incorporated, a national network of independent life insurance and wealth management advisors. Michael specializes in developing sophisticated life insurance solutions to meet the sophisticated needs of high net worth and business owner clients. And a big thank you to our sponsor for this webinar, Protective Life. They are on a mission to protect more people by making security and financial freedom more accessible. Their commitment to reliable, competitive life insurance and annuity products goes hand in hand with their dedication to supporting you and serving your clients. Visit their website, finpro.protective.com, to learn how together we can all be protectors. Please ask any questions that you may have in the questions pane during our discussion, and we will get to as many as we can at the end. And with that, I'll turn it over to John.
Thank you, Ashley, and thank you to everyone for joining us today. We're very excited to have such a strong and diverse panel with us today to talk all things life insurance. I'm especially pleased that we have folks from both the traditional life insurance background as well as the traditional advisory background. Life insurance is a very versatile product, and our panelists are using to solve a variety of planning and retirement needs. We have a lot of great stuff to get to here, so I'm just going to get out of the way and get to it. But first, let's get a sense of who is in our audience, Ashley. So I believe you have a poll for us.
The first poll is just, what is your role? Are you a financial advisor, an insurance agent, in distribution, with a financial company, an insurance company, or support or back office? It looks like the majority of our audience are insurance agents, followed by financial advisors.
Great, thanks, Ashley. I'd like to set the stage for our discussion here with some general thoughts on the value of life insurance in your clients' retirement portfolios, especially given the current conditions with the economy and coming out of the pandemic. Give us an idea of how you're utilizing life insurance for your clients today. And Jennifer, why don't you start us off?
Sure. Thank you, first of all, John and Ashley, for asking me to attend today. And it's also great to meet Guy and Michael and work with them today on the panel. So from a carrier perspective, Legal & General, as some of you might know, or a Banner or William Penn, there's about 4 areas where we're really focused on how to contribute to a better life insurance experience so that advisors and agents can give a better experience to their customers. One of the things that we actively work on is around affordable pricing for our agents and advisors. So we are looking, and we use AI and speed at about 28,000 different pricing cells. So that's something that we've been working very hard to bring to market, the best, most affordable pricing around 3 to 4 days. And so that makes it easier for agents and advisors to offer these products to their customers. Another area where we've been really trying to make a lot of headwinds and be very innovative and cutting edge, and one of the first the first insurance company to be an end-to-end digital process, is really working with different types of digital journeys with agents and advisors. So in some cases, clients want to handhold and work with the client all the way from an end-to-end perspective with a customer and fill in the data and work through all the data needs to get to a policy or to a price. In other cases, there's agents and advisors and distribution partners who'd like to offload that information for a client to fill out on their own, because in some cases we find clients are more apt to be I would say, open to their health information if they're not telling an advisor or an agent. So we toggle between multiple journeys with agents. So an agent can do it together, they can do it separate, a client can start, stop, an agent can come in and take over. And it really saves time for an agent or advisor if they do want a client to fill it out. So what we're finding when we send a customer link with the approval of the agent or advisor, that 95% of the time we're seeing the client completely finish the application that they've started. So again, and it's working with behavior change with agents and advisors, as well as helping them to trust the process, right? And trust the outcomes. And that's something we're working hard on every day, and getting the feedback about helping to build that trust, because it really hasn't been there, I think, in multiple decades, to understand what those outcomes are, especially living in this digital area. A third area where we've really been working hard is around impaired risk, and really bringing in the best underwriters in the industry so that we can provide better cycle times for agents and advisors, and really make this easier to cover more families, more individuals, and more businesses. We're not quite there in the digital process around impaired risk, but we're really working hard. And that leads me into the next area around the technology and data, is really using robotics and AI and multiple data sources to really make this process easier for agents and advisors and customers right now. So to date, we have about a 50% instant decision rate for customers under the age of 50 and below. And what we are finding, though, is challenges, particularly around even getting more instant decision, or even getting into helping impaired risk being easier, faster processes, is around the data quality. Using EHRs, it's not yet all the way there. There's still not a lot of standard approaches on how doctors are relaying information from one doctor to another, how it's being read through robotics, how it's being assessed. So I would think data quality and consistency is one of our biggest challenges to even making cycle times faster and easier. So those are really the four areas where we've been really focusing hard to make it easier, better, faster for our customer base, which are agents and advisors.
Oh, great stuff, Jen. Thank you for that. Guy, you want to pick it up and give us some thoughts on how you're using life insurance today?
So I've been in the business, 57 years, and I don't find that the sale of life insurance is any different today than it was when I first started in the business. The big difference for me is that I think I'm a lot bolder and take much more of a leadership role with my clients than I ever did. What I see today is, a real need on the part of clients to have somebody help them figure out what it is they want to do, and then show them the best way to do it. So, from a products perspective, there's a whole range of products that can be used in that regard. When I first started in the business, I had term and whole life. That was it. Today, the potpourri is amazing, but all life insurance works the same way. It's all based on mortality costs. And so what I tell clients is all life insurance is term insurance. It's just a matter of whether you're going to pay the premiums with your money or tax-free compound interest. And when people understand what the differences are, I find very few people really want to buy term insurance unless it's the only thing they can afford. So it's an exciting time, I think, to be in the business. There's a lot of opportunity. Life insurance is an asset class. Life insurance is a retirement benefit. Life insurance is a business continuity. So for all of your listeners out there, I would just suggest that they do everything they possibly can to educate themselves on the needs, the problems. And once you understand the problems, the solutions are pretty easy.
That's true. Thank you, Guy. Michael, anything to add to the discussion here about life insurance?
I would echo Guy's comments. I'm not sure there's a whole lot I can add here as far as this kind of high level general question. I mean, we're, as the saying goes, there's nothing new under the sun, and there's really nothing new in the life insurance industry for the most part. I mean, products are changing and getting more sophisticated, and and evolving. And there's new ways in which we can, design and incorporate life insurance into the overall planning that we're doing for clients. But Lion Street primarily focuses on, or I guess our primary constituent, if you will, is from a consumer perspective through our roughly 200 firms across the country, are clients that are higher net worth and or business owners. And so we generally do a lot more sophisticated design work and a lot more sophisticated planning, whether it be for affluent and high net worth clients to help plan for estate tax liquidity, or whether it be for high income earners that are before retirement, looking at not only providing protection using the death benefit component, but also grow additional wealth in a tax-free location using the investment component, the underlying cash value. And we use all types of products. We don't advocate for one product over another. We base that decision on risk tolerance and what type of underlying risk and reward characteristics the client is comfortable with and looking to achieve. And so we just optimize either one of those components based on what they're looking to accomplish. If they have a protection need, we design the life insurance to maximize the protection and minimize the cost, out-of-pocket cost, that is, to the client. If they have a accumulation need, we look at maximizing the investment component and minimizing the protection component. And there's a lot of obviously very nuanced and specific applications. Like I said, once you understand the need or the problem, then the design and the product selection kind of follows that. And I'll talk a little bit more specifically here in our next series of questions about how we're more specifically incorporating life insurance with those types of clients. But for now, that's all.
Sure.
John, before we jump,
Yeah.
can I ask Jennifer a question?
Absolutely.
Yeah. So Jennifer, I'm really intrigued by this 85%, I think is what you said, almost instantaneous approval rate. With the increase in mortality that the industry is experiencing and reporting here over the last few months, is that impacting your decision-making process at all? How are you integrating that?
So we're constantly looking and analyzing mortality data and working actually with our board and with our group in London analyzing. But right now it's and through the pricing, but we're back to pre-COVID times on our mortality outcomes. So when we take out the COVID claims, we're actually seeing we're not seeing any sort of jump in our mortality risk and exposure right now. So we're always looking at how to reduce our costs to bring out the best price. But right now we're very solid on all of our mortality data and our tables right now.
Thank you.
Yeah, thank you.
Yeah, that's a great point, Guy. I listen to earnings calls, and I'm always, since the pandemic, I'm always really, my ears pick up when they talk about mortality. So no, that's a good point to cover.
And I have a thought to add on that too, John. We pay attention a lot to those types of announcements and commentaries, and we subscribe to Alert, which is a third party, essentially kind of a ratings agency that has their own methodology for assessing financial strength. And they've noted the last couple of years an increase in mortality experience across the industry, but based on their metrics and analysis, have concluded that it's well within manageable levels. And that's also the similar feedback we get from carriers that we have very close relationships with to get inside scoop feedback on what they're seeing and experiencing. So although there has been a spike, it's well within manageable levels, and the industry is well capitalized to sustain itself through that and handle any short-term spikes in mortality. And also a lot of the increase in mortality has been in the group life insurance, the non-underwritten life insurance kind of segment of the industry. So overall right now, from what we're hearing and seeing, it's very manageable.
Okay.
And even with some of our new distribution partners, Guy, where we have exclusive products as well. We've been monitoring that heavily as well. And we have not seen any sort of, because some of the new distribution partners came on during COVID. And when we again stripped out the COVID claims, we were all within the manageable levels.
Okay, very good. And we are going to get a little bit into distribution coming up here, but let's drill down a little bit into some of these life insurance issues. We'll start with Jen. I know you're leading some interesting growth initiatives across Legal and General's insurance division. Why don't you give us an update on maybe one or two things you're working on to grow in the life insurance space?
On top of what I really spoke about at the beginning, one of the things we're really trying to do is improve the whole experience part of the buying process. And because we know we can offer the price and the product and the process, and we're spending a lot of time enhancing and making that process piece much better for agents, advisors, and customers. And so we're doing that through advisory, we're doing that through monitoring of data, because now since everything's digital, since everything is sitting in what we call our horizon process, we can constantly look at the touch points about what's dropping in, what's dropping out, what needs to be improved. We get weekly input. We're constantly prioritizing with our technology team, our underwriting team, and our operations team what needs to be fixed or enhanced for prioritization and impact. So we're constantly innovating. That's really my first point. Another place that we're also really working on is, again, bringing on new distribution partners, because we know there's over 100 million people in the United States, individuals, businesses, families that lack coverage or have a lack of a gap of the life insurance. And so what we've been doing is looking for new, different types of distribution to reach those customers. In some cases, those customers need proprietary term life products where it might not be as price sensitive, but they want higher instant decisions. They want faster cycle times. So we'll price for those. In other cases, they want 48 hour turnaround time. So how do we work with our operational units? And so we've really gone beyond what I would say Legal in General and Banner Life has been known for in the past, and really entering into all of these different types of distribution channels so we can use our digital process to adapt very quickly. And what that means though is we need to partner with companies who want to simplify that customer experience as well. And so that's really where we are now. We've moved from 2 very large customer segments into about 5 different types of segments right now. Working with like a very, very large financial advisor nationally. We just went live about 8 weeks ago. And so we're learning constantly, and we're adapting and trying to make it a much easier process and experience.
Oh, excellent. Thank you, Jen. Guy, I'm sure we could do an entire webinar on the book, The Box, The Mathematics of Life Insurance, which is an appropriate title and topic for our discussion today. So give us the elevator version of how you feel life insurance is evolving to address middle market needs.
So I was in a meeting with 5 accountants, and I think this was the 5th meeting I was having with them, trying to explain to them why permanent insurance made more sense for funding their buy-sell than term. And they just were not getting it. So finally, we decided this was the last meeting. And I put the pen down on the table and I said, do you guys understand how life insurance works? And of course, every one of them had this deer caught in the headlights look, right? So they had this was a few years ago, so they had a flip chart. They didn't have a whiteboard. And I went up there and I taught them CLU Part 1. Essentially, I just did a synopsis of it. So I showed them, how a mortality curve was made. I showed them what a mortality curve looked like. I showed them what the life expectancy statistics were, and I showed them what the cost of term insurance was at life expectancy. And we'd done some research on this, and it turns out that since life insurance is a mathematical science, right? It's based on the predictable probability of death. Every insurance company has to have calculated and accumulated the total mortality costs needed to be actuarially sound at life expectancy. And that's 74%. And then if you go out to the first standard deviation of risk, it's 119, which is like 7 years plus life expectancy. And the second standard deviation is 240,000%. So I asked them the question. I said, if you bought a term insurance policy today and you reached your life expectancy birthday and the premium was $150,000, what would you do? And every one of them said, well, we cancel it. And I'd say, well, what if you just found out you had terminal cancer? What would you do? And so then that led to a discussion of how the insurance industry morphed in the mid 1800s, because every insurance company went bankrupt because the only type of insurance they had was mortality-based insurance, term insurance. And then I showed them the box, and I showed them how you have to put this much money in the box to pay the curve. And as long as you have this much money in the box to pay the curve, you don't ever have to worry about it. And you can put more money in the box, and, you know, all the permutations on that. So that worked so well. What they said was, okay, let's do it. And I said, do what? And they said, we'll buy it. Well, and I said, why? And they said, well, we understand it now. So I went to lunch an hour later, you know, and I had a meeting with this woman that wouldn't buy any insurance either. I showed her the same story, and she said, okay, I think I'll do that. And so I said, maybe I have something here. So I took my notes and I put them in the drawer of my desk, and I looked at it about 5 years later. But after a while, though, I decided that I was going to use that story with every life insurance sale. And, you know, it's kind of interesting, Jennifer, you talking about distributions, and then I'll turn this over to Michael. But, you know, the one thing that the agent has that you can't do with AI, and you can't do with social media marketing and that type of stuff. You know, you got knowledge, you've got data, you've got strategies. Those three things can be packaged and marketed with AI, and, you know, you can send out agents with PowerPoint presentations. The one thing you can't market and duplicate is wisdom. And that's really what years of experience in this business brings. And the more you hone your wisdom, the higher the probability is you're going to be successful with your high-end clients. So I would just encourage all of your listeners to spend a lot of time talking to people that have been around a long time, learn the ins and outs and the strategies and how to apply it and what the needs are. And you know, it's like I said earlier, and Mike reiterated, you know, the problems are really where the sale is. You know, the solutions just come naturally. And I've spoken to many audiences and asked them, what is it that we sell? And they all say we sell solutions. But the fact of the matter is, we don't sell solutions, we sell problems. And, you know, when we sell problems correctly, we will sell a lot of solutions.
It's good advice, Guy. Thank you. So that moves us on to Michael. I know you work with a lot of high net worth clients at Lion Street. So talk a little bit about how life insurance can help those folks with tax and estate planning needs.
Yeah, I mean, that's a pretty big toolbox to start unpacking here, obviously, because there's a lot of different applications. But where we spend a lot of our time with high net worth clients is helping to design the life insurance to provide liquidity and wealth preservation over multiple generations, and that can take the form of you know, it can take many different forms. Right now, as we all probably know, in the audience, the estate and gift tax exclusion amounts are historically high as a result of the Tax Cuts and Jobs Act, which temporarily doubled the exclusion amount per donor, but that had a expiration date attached to it, which is January 1, 2026. So the doubled exclusion amount right now is temporary. And in order to use the bonus exclusion, which is the top half of that doubled amount, you have to first use the base exclusion. So this year, an individual can transfer up to just over $12 million gift and estate tax free to someone else other than a spouse or a charity. But in order to use the bonus amount, you have to first make a gift of $6 million in order to get to that additional $6 million. So if you only make a gift of $6 million today, you have not used that bonus exclusion amount. And if you don't make any additional gifts, then after 2025, you've lost that additional opportunity. So that's what's driving a lot of the planning right now that we're seeing in the high net worth space from an estate planning perspective, is showing clients why and how to make use of that bonus exclusion amount to lock in that ability to transfer an additional $6 million, transfer tax free to their junior generations or a trust for the benefit thereof. And then that also leads into a lot of discussions around life insurance, because obviously life insurance is the most effective way to provide liquidity at death of an individual, to provide the ability for the estate to pay the estate tax when due. And now that we have all this money in a trust, it then provides a lot of source for premium dollars potentially. And we talk about the advantages and the benefits of why life insurance is the most effective way to provide that liquidity, the additional benefits that it can provide from an estate planning perspective that many advisors and clients just don't intuitively think of or are familiar with, such as the ability to potentially leverage the gift and leave a larger inheritance to their beneficiaries, to provide liquidity, maybe to offset post-death capital gains taxes that are embedded in trust assets. Because when someone makes a gift to a trust, it's a carryover basis event, not a step-up in basis event like it is if they retain the asset until death. And after the individual dies, if the trust, after the donor dies, if the trust sells an asset that was accumulated or accrued inside the trust, it's going to incur a capital gains tax, and that could potentially be, depending on where the trust is cited, anywhere from 23.8 up to something higher than that. Whereas life insurance, when the death benefit is paid, it's received in cash, and that cash is not taxable to the beneficiary, generally speaking, under current law. And so it naturally gets a basis step up effectively, even outside of the individual's estate. So if your cost basis in the policy was $1 million and the death benefit is 10 million, well, the new basis in that asset when received by the trust is 10 million, because the trust doesn't pay income tax on the receipt of those proceeds, generally speaking. And so that can provide a very effective way to offset post-death capital gains taxes from other gifted assets that have embedded gains inside of them that don't get a basis step up when the individual dies because they're not included in the estate. And then Guy mentioned this a minute ago. We've actually written a trust and estates article on this topic, and have developed a very sophisticated analysis tool that helps to put numbers behind the concept. And if anyone's interested in reading about this, you can go to trustandestates.com or wealthmanagement.com/trustandestates, whatever the website is, and search for this article. It's a very, very compelling discussion around life insurance as a contingent asset class, where we provide a methodology to assign a portfolio value in terms of both expected return and risk to the death benefit using modern portfolio theory principles. We basically modified the typical tools, the statistical tools used in modern portfolio theory to account for the contingent mortality nature of the death benefit, and assign a mathematical value to the expected standard deviation of the death benefit, so that we can then plot out the expected return and risk of the death benefit itself on a XY scatter graph, and compare it to other types of traditional investable assets from a risk and return perspective, as well as the impact to the overall portfolio in terms of risk and return, and most importantly, risk adjusted return. So we talk about that a lot using some of the tools and the resources that we've developed on how to get high net worth clients, and more commonly the advisors to those clients, whether they be family office professionals or wealth managers, et cetera, on how to view life insurance through a different lens other than just the estate tax liquidity or wealth replacement lens, which it does very well, obviously, but this is more of a portfolio approach to incorporating the death benefit into the portfolio. And what's great about the analysis and that approach is that it takes the focus off of the rate of return or the IRR on the death benefit, and kind of shifts it over to the expected risk. And what most people don't realize is the overwhelming largest part of the benefit of a death benefit from a wealth transfer perspective is not in the IRR. We want a good IRR. We want to design the policy so that it provides a good outcome for the family in terms of return on investment, of course, but it really lies in the very low risk nature of the asset. And that's really where the portfolio value that it can add resides. And that whole discussion really helps advisors kind of see it in a different light. And we've heard countless times from family office professionals and wealth managers when we talk about things like standard deviation, Sharpe ratio, et cetera, and they say, now you're talking my language. And it just gets them to see the benefits of life insurance in a little bit of a different way. And we've had a lot of success with that in that discussion, and showing how it can be another way to reduce risk while still providing an acceptable and attractive rate of return on the client's investment.
Oh, okay, great.
John,
Thanks, Michael. Good stuff.
Just to kind of piggyback on that real quick, with the mark-to-market problem we've got with bonds, life insurance is a tremendous asset class because you don't have to worry about those changes in valuation. Additionally to all the things that Michael said, which were great, as always. We also deal with life insurance as an equalization tool. You know, I mean, a lot of times you got families that have 4 kids and 1 is in the business or 2 is in the business. How do you, if 85% of the net worth is in that business, how do you deal with those types of issues? So life insurance becomes a great equalization tool. He mentioned the income tax side of this when you do sophisticated planning with intentionally defective trusts or beneficiary defective trusts. You know, those are always big problems because you're giving up a huge income tax relief on the step up in basis in exchange for an estate tax. So if you can get both the relief from the estate taxes and cost recovery on the income tax, you've got double duty there, and you've really helped the family in a way that nobody else can do. So, there are tremendous tools in the tool chest, as Michael said, and I think, the more you know about the problems, the more you know about the solutions. So,
Yeah.
redundant.
And can I add to what Guy was saying as well? I know it's something we're going to talk about a little bit later, but I'll pull it forward. But there's 13 million single parents in the United States as well, and 80% of those are women, raising over 21 million children. So there's a huge opportunity to help educate and help prioritize, I think, particularly around females, the need for life insurance, particularly in those scenarios around college and care and mortgage and debt. And women do live longer. So in essence, women's life insurance is typically, depending on health, is cheaper than men. But we're seeing a huge opportunity with 40%, I think only 47% of women have life insurance. There's an opportunity to really fill that gap as well. So I just sort of wanted to add to Guy's conversation around the opportunity as well.
Yeah, that's great. I had a conversation this morning with a 26-year-old who's single, that's thinking about getting married and having children, and he's already thinking about private school, college education. Well, what better way for him to start planning for that now than to buy a very significant life insurance policy and build, $200,000, $500,000, $1 million of cash values in the next 20 years.
Right. Well, with Legal in General, he could do it for 40 years because we're one of 2 carriers that offers 40 years.
Well, that's a good jumping off point for a question I have here, Guy. So folks in our audience, I'm sure, could benefit from this question. How do you convince a client of how much life insurance they need? I mean, what are some key considerations to convincing them of that number?
Well, 2 of the best ways to frame that discussion was Tom Wolfe's capital need analysis and the American College human life value methodology. And, either one of those can, be a fairly quick discussion in terms of the right amount of insurance. The way I usually do it, and again, I was talking to a client of mine that called me the other day, and I've sold him $1 million of insurance, and he's had 2 children since then. And I was saying, how much income do you want your wife to have, and do you want her to pay off the house? And when he said, yeah, absolutely. And I said, well, what's that income number? You multiply that by 0.04 or divide by 0.04, and you've got your number, right? So, I mean, it's not difficult to make a case for $3, $4, $5 million worth of life insurance. The harder question is getting the underwriter to approve it.
Okay.
That's where we come in.
All right, good stuff here. We're a little bit behind in our questions, but I do want to bring Ashley back in. I think we have a second poll question that is really interesting. So Ashley, you want to do that one?
Yeah, so the next poll we have is what life insurance product is most popular with your clients? It looks like the majority of our audience said IUL, followed by term and whole life were tied.
Okay, thank you, Ashley. Very good. Interesting data there. I do want to come back to an earlier question that I had, and a very important topic, and that is long-term care. I recently got some data from LimRush indicating that long-term care riders and combo policies are selling really, really well. So do you recommend these products? Why or why not? How can we incorporate long-term care needs into the sale of life insurance? And I'll throw it open there to anyone. Michael's nodding. So you want to start?
Sure. Yeah, we as an organization, we don't do as much with those types of products and features as probably others do, not because we don't believe in them. It's just that a lot of our firms, because they work with such sophisticated clients, they kind of have a preconceived notion that their clients are not going to want it or need it. And one of our firms once said, my clients can just buy a nursing home. Why would they want to buy long-term care insurance? And although there might be some truth to that, as far as, once you get up to a certain level of wealth, maybe the financial need might not be as great as what it would be on somewhat of more modest means. But still, if you can insure a risk, a contingency with something that's more efficient than doing it with your own funds, why wouldn't you do it? And so we still talk about it a lot. We still, we sell a fair amount of it. I would just say probably not as much as other organizations do, but the common form of that type of rider or feature that we see more often than not is a traditional long-term care rider or a chronic illness rider attached to a traditional life policy, where you have a bigger death benefit, and then the death benefit can be accelerated due to long-term care and only up to the amount of the death benefit, as opposed to the asset-based hybrid products where you have a small death benefit and much bigger long-term care pool. So that's where we see most of it in our world. And we look for riders generally that pay an indemnity benefit, that don't have a permanency requirement on the eligibility criteria for the condition itself. And we even like attaching it to, as long as the benefit pool for long-term care or chronic illness can grow with the death benefit over time, a cash value accumulation focused design, where you have a retirement, you have obviously a death benefit, you have a retirement benefit, and then you have a long-term care benefit as well that can grow with the overall death benefit. And the way that we see it is it just provides a lot of flexibility, because it's impossible to predict what your needs are going to be in the future. And as confident as we are that we're going to live forever and never get sick, obviously stuff happens, and health costs, medical costs, et cetera, are one of the largest expenses in retirement for individuals. And a lot of that is due to unexpected long-term care costs later in life. And it just adds a tremendous amount of flexibility to the policy, whether it's a protection focused policy where you got the death benefit or the chronic illness benefit, or like I mentioned, a cash value focused design where you have death benefit if you die too soon, cash value if you live too long, and long-term care if you become chronically ill along the way. And we've been talking about some more sophisticated ways in which to incorporate it into one's estate plan, using policies owned by trusts and with specific types of riders. There's actually ways that you can design a trust-owned policy so that the benefit that's being accelerated to the trust can be used for the benefit of the donor or the grantor of the trust, who's the insured, who becomes chronically ill, through either making a distribution to the beneficiaries and having them make a tax-free gift to the medical provider, or having the trust make loans back to the grantor, which are repayable from other estate assets when he or she dies. And so there's just a lot of flexibility that it can provide for individuals, whether they are lower end in terms of net worth or higher end.
Okay, good stuff, Michael. Jennifer, you want to add anything there?
Sorry, I was on mute. That's actually not a place that we sell products. So it's something we're definitely looking into and partnering with and understanding as we expand our product portfolio. So probably Guy might be a better person if he wants to add any more.
Yeah, sure. So my mother lived to 1 month short of 90. Okay. And if I'd have bought a long-term care policy on her, I would have lost money because she never would have made a claim. And that convinced me beyond anything else that the life insurance funded approach to long-term care made the most sense. And that's the way I sell it to my clients, is I tell them, look, you've got the life insurance policy, it's going to deliver a death benefit. If you need it for long-term care, then we can drag down from the death benefit and we can pay for your long-term care needs. So I think that's one of the most brilliant products that the insurance industry's ever come up with. I have to tell you this, and I hope this is taken the right way. But back in the mid 80s, early 80s, I was back in New York at a major insurance company, and I gave them this whole idea, except that I also added disability to it, that a life insurance policy could be premature death, it could be retirement, it could be long-term care, and it could be disability. And as they patted my head and sent me out the front door, they said, "Thanks for coming by." But here we are today. The only thing they haven't added is the disability piece, but it could be a disability policy too.
So Guy, maybe we'll be tapping into your knowledge as we're looking to expand our portfolio.
Well, that would be fun. You can pat
That
me
would
on
be
the head
fun.
too. You can pat me on the head too.
Yeah, and I'll just reinforce something Guy said there. The use it or lose it aspect is something that many people just don't like about traditional long-term care insurance. And in addition to the fact with whether it's a traditional life policy with a rider or more of a hybrid long-term care life combo product, you don't have that use it or lose it. Obviously, if you don't use the long-term care benefit, you got the death benefit or cash value, depending on the type of product it is, et cetera. And so that causes a lot of people to gravitate towards the life insurance chassis to provide for that ability to have that long-term care coverage as well. But the other thing that's very important for people to realize too is think about what's happened in the long-term care industry over the last 10 to 15 years. There's been a tremendous amount of claims experience that the carriers did not properly assess or predict or expect when they sold a lot of traditional long-term care policies in the 90s and early 2000s. And that's led to a lot of substantial cost increases on traditional long-term care policies. When I was on the retail side of the business many years ago, I sold my parents a long-term care policy. And we specifically designed it to be paid up at age 65. And boy, am I glad that we did, because they experienced a few modest price increases before they retired. But once they turned 65, they don't have to pay any more premium. But a lot of people didn't do that. And they've been having to get these, annual cost increase notices and stuff like that. Now, depending on the type of life insurance policy, there may or may not be guarantees with respect to the premium or the underlying cost of insurance. But on a life insurance chassis, it's a much more predictable risk and a much more manageable risk to the life insurance carrier, because they know exactly how much they're on the hook for, and they can build in kind of the morbidity pricing into the mortality pricing and come up with a much more manageable, predictable way to offer that benefit. And so we see much more price stability on life insurance policy chassis with long-term care and chronic illness riders than we do with long-term care. So that's also something that's very important, and that causes a lot of people in our experience to gravitate towards those types of solutions as opposed to traditional long-term care, as long as they can afford, obviously, the higher premium, and it makes sense from a death benefit protection standpoint as well.
Yeah, you're absolutely right. It's that unpredictability that has made a traditional long-term care approach so unpredictable.
Mm-hmm.
Okay, good stuff there. I'm sure we could do another whole webinar on LTC, but I do want to touch a little bit on distribution. I think, Jennifer, you have something on this. Maybe talk about how distribution is evolving as you strategize to enter new markets.
Sure. I covered a lot of the topics earlier, but we're looking at lots of trends that are happening right now. And I always say a trend is your friend until it's not. So it's been very hard to actually develop trends from 2020 to 2021 to 2022 because of the sort of the demand changes in the market because of the pandemic. So demand drove a huge amount of need for term life because it's easy to buy, it's easy to understand typically, and there's a huge supply. And so as we were looking at what the sort of pandemic did to our industry, is it really drove a lot more need and demand for instant decisions, accelerated underwriting, automated underwriting, the use of existing data like the RX data, electronic health records, lab data to really get to a decision as fast as possible. But now what we're seeing is, as we sort of turned into 2021, we're seeing with the economy shifting, inflation rising, prices rising, the market that we play in, we're actually seeing demand go down. So around the lower face value, 2 million and under, we're seeing demand go up for 2 million and higher. And so this is where we're actually trying to do two things: is make it still continuously easier, better customer experience for the 2 million and under, and also really challenging ourselves around our financial underwriting guidelines to really make that 2 million and above faster. So we wrote over 100,000 policies in 2021. Just to give a scale of how many term policies we write, we have about 1.4 million enforced term policies. So a lot of data to look at, a lot of data sort of assess where we're going next. So I would say really improving that financial underwriting experience for the 2 million and up, and really making that customer experience much more solid for all levels of in different types of distribution, whether it's an advisor, an agent, InsurTech, who is more lead generation, more hands-off, less relationship-driven, multi-level marketing agencies that are having multiple agents in play to bring in life insurance. So that's sort of what we're constantly assessing and looking at.
Okay, good. Any thoughts, Guy or Michael, on distribution?
Well, the first thing that I heard was 1.4 million term policies ought to all read the box. So they could maybe convert some of that. I'm reminded of the Wayne Gretzky method of planning. You go to where the puck's going, not to where it's been, right? So I think all the advisors out there that are listening ought to be thinking about, where is the puck going right now? It was clear 10 years ago that the puck was going to business succession, with the boom of baby boomers, retiring and having to get out of their businesses. And, now I think that we're dealing a lot with retirement. And the three questions that I like to ask is, do you know your number? How much do you have to save to get to your number? And do you have a good way to invest it? So, distribution can be seen from two perspectives. One is Jennifer's perspective, which is to get the story out to the agents. But the other perspective is us getting the story out to our clients, and how to find more people, if you will, that we can talk to about the wonderful products and solutions that we have.
Okay, good point, Guy. Jennifer, you mentioned a little bit on InsurTech and technology, maybe there. That's a good trend to touch on. I wrote a lot of stories during the pandemic about accelerated underwriting and some different things. So are you seeing that those trends continue? And any thoughts on where technology could take life insurance in the future?
Yes, so sort of two sides to it are, I would say we're seeing a lot less capital being invested in some of our technology partners. So that's been a great challenge coming into 2022, because that's all about the lead generation. We're also seeing a lot of our technology partners who were more of a D2C model now wanting to enter into the agent space as well. So we're sort of seeing a merging of distribution and sort of figuring out how to be partners with the change, as well as ones that are not moving or blurring into multiple distribution segments. The other side of technology, I would say, is what we're seeing as definitional challenges. A lot of carriers will say we're instant, we have automated underwriting, accelerated underwriting, and really, what does that mean? So like how we define it is instant, 20 minutes or less, you have a policy, right? And so, and I would say the accelerated underwriting, in our words, is we really monitor the 5 to 10 day, how much business. And so we actually have one of our KPIs around making that number get bigger and bigger and bigger and faster. So more policies getting through using different sources of data. And that's something that we look at actually every single week as an organization on where we're going to invest to make that 10 day and under faster. How much can we get through in 5 days as well, without disrupting the relationship. The relationships with our advisors and agents are really, really important. And we still see behavior changes that are still happening between the advisor, agent, and their clients. Again, back to the earlier discussion around trust. Like trusting the process. So if you're offloading a process to us, let us handle it. Let us get the client to fill it out. Let us give you a price and a policy. And I think that's going to get better and better over the next 2 years as that trust builds up, that it's working, and that more importantly, advisors and agents can check in on their statuses and understand where is the policy in the pipeline. Because to Guy's earlier point, we want to provide the products, the process, the experience, but our advisors and agents are actually the ones going and finding the clients. So it's like, how do we make this as seamless as possible? And that's really where we're trying to actively play and be better.
Sure. Michael, follow-up, Guy?
Yeah, I would add on top of that what Guy mentioned earlier about Wayne Gretzky's quote: "You skate to where the puck is going, not to where it is." Clearly, where the industry is going is towards more of a digital experience from end to end, as opposed to the antiquated, paper experience that has kind of been the norm for decades and decades and decades. And the pandemic kind of accelerated, no pun intended, the use of accelerated underwriting technologies, or the development of accelerated underwriting technologies by many carriers out of necessity, which was, probably a silver lining from our industry's perspective of the pandemic. And we see that as a huge advancement and where the industry is going, and something we try to leverage as much as possible. And we even see some innovation from an underwriting perspective, even in the bigger face amount scenario. So a lot of those accelerated underwriting programs are limited to lower face amounts, but there are certain carriers out there that we have very close relationships with that even for sizable face amounts, all the way up even sometimes to their jumbo limits for reinsurance limits, they allow for either accelerated underwriting or not maybe accelerated, but maybe fluidless type underwriting. They can use information from an executive physical that they may have had recently, as opposed to having to go out and get new labs and stuff like that. We're actually building a completely digital end-to-end experience for our firms to use, from being able to enter the case into their CRM, to submit it informally, to convert that to a formal application, to take advantage of any accelerated underwriting programs that carriers offers, and then deliver the policy electronically as well. And for anyone on the line here who's familiar with Penn Mutual's ACE program, which stands for Accelerated Client Experience, as soon as they launched that several years ago, we immediately jumped on that and are using that underlying technology as the engine to drive what we're building here, because that's just where the future is going for the industry. And I think more and more carriers, if they haven't already, will choose or be forced to follow suit there, which is very needed and very welcome, because it's been such a painful process to get policies placed in our industry for many years. And so for things like what Jennifer mentioned, what Legal & General are doing, and other carriers, that's a huge step forward, and will be where it's at going forward.
And Michael, it's interesting you mentioned the paper, because we find that we actually just recently moved to 100% digital. So we dropped our paper app, and with a lot of training to make sure we can ingest the paper app into the digital process, so it gets all the fuel, the instance, the accelerated, the automated. But again, it sort of goes back to this behavior change of trust, because I think a lot of people trust the paper app. They sort of trust that process. So again, it's a start, and we're encouraged by our agents and advisors to sort of rip the Band-Aid off and go to it, knowing that we could experience a short-term loss of business as this change gets better and better. But we agree with you, because that's sort of where that puck is going.
Okay. We are 2 weeks into Life Insurance Awareness Month, so seems appropriate to close with this question. Some of the data I'm seeing lately indicates that the enthusiasm for life insurance is starting to kind of wane a little bit now that we're 2.5 years into COVID. So what can the industry do to get that momentum going again and keep it going, or pick up the momentum for life insurance? So Guy, you want to start off with this one?
Well, as I mentioned, after all the years I've been doing this, I have learned one thing, and that is that life insurance is not a demand product. You have to push it. So I would have to say, yeah, the pandemic got people maybe more aware of their mortality, so it brought them out of denial. But most of the people that we work with are in denial. They think they've got all the solutions they need for all the problems they've got. That's why we're problem merchants. And our job is to help them understand the problems they don't understand. And as long as that dynamic, that human nature dynamic exists, we will always have a job. Once that goes away, then, well, I might have to go push a broom or something. But until then, we're all about helping people get out of denial. And I just don't see that changing.
Okay.
Yeah, and one thing we see as a big challenge for the industry is agent succession. I mean, we all know the average age of our, the average life insurance agent looks like Guy. No offense, Guy.
I hope they don't.
Yeah, in their average age in their mid to upper 50s, and probably retirement on the horizon the next 10 years or something like that. So the industry really needs to find new ways to like Guy said, to merchant those problems and reach the consumer, and new ways through which to reach the consumer, which is finding new distribution outlets, training younger people to come into the business outside of the career distribution system, which is kind of been diminishing over the years, and provide new channels through which to, or access new channels through which to reach those consumers, whether it be through banks and wealth management institutions or whatnot. But that's something we think a lot about here at Lion Street as well, because the average age of our producers is probably a little bit younger on average in the industry, but still we have a lot of very seasoned life insurance and financial advisors that are going to be retiring soon. So if we don't have people to go out and to convey that message and find the consumer and talk to them about the problems, then it's going to be a real struggle and challenge. And the biggest challenge we see in that area is training young people to come into the business. And because most successful life insurance agents just don't have the ability or the expertise to do that.
Or the patience.
With the patience, right? Exactly. So that's something the industry really needs to, I think, step up on.
Yeah, I think
another problem. Oh, go ahead. Sorry, Guy.
Real quick. I think another problem is the business model that the industry has. It's not conducive to building organizations or building succession. And I think if the puck has to go anyplace, it needs to go there to try and change the business model to make it more conducive, so you've got cash flow to be able to build a business. Sorry, Jennifer, I didn't mean to jump on.
Always trying to, I think, really to both of your points and more to Michael's about bringing young people in. I'm always having conversations with the Uber driver, like the Starbucks person. I mean, I'm always asking questions how they think about life insurance as well and the need for it. And just having these personal conversations, or even friends challenging couples or people who've been divorced or single people. I mean, I come across people every day, and I always just have this conversation. Have you thought about? And it's really interesting, the reactions, because a lot of times I think individuals feel like they're being sold. I had one colleague or a friend outside of the industry who was a professor, and he said, oh yeah, I never bought life insurance. I got away without having to do it. And I said, well, what about your kids? What about college? What about your mortgage debt on top of your house, leaving it to your wife? And all of a sudden he just stopped and he froze, And so I just think there's still a lot more about going after the sort of the youth and sort of explaining that sometimes it's only the cost of a couple of Starbucks a month, and you get moving on that financial mindset too. So that's just something I think about often, but there is still opportunity.
Jennifer, that's the denial that I was talking about.
Yes.
See, and you were able to bring him out of denial for him to have that aha moment.
Right. Exactly. So that's what made me think of that story when you mentioned that earlier.
Okay, really good stuff. We're coming to the end of our time, but I do think we have a couple of questions. I'm going to throw it back to Ashley now for that.
Thank you, guys. Michael is answering some of the questions. People had specific in relation to a document that he had mentioned, so he took care of that. But one of the questions we have from the audience is, what do you think about convertible term? Maybe a client can only afford term now, but in the future they could convert.
It's a great product. All terms should be convertible.
Yeah, we specifically advocate against going with cheap term that doesn't have strong convertibility, because very rarely do we come across someone who buys term and gets to the expiration date of their term policy and says, oh, I don't need it or want it anymore for some reason or purpose. So especially in our marketplace where we're dealing with much more higher end clients with much bigger needs. A lot of the time, term insurance is used as just a temporary, band-aid from a cash flow perspective until they have a liquidity event or have more available cash flow from their, business or whatever. And so when we place large term insurance policies, we always do so with products that have strong convertibility options, and specifically strong convertibility to any product that's available in their portfolio at the time of conversion, so that flexibility is preserved to be able to convert it over to permanent, because most likely it will be.
Okay.
Excellent.
I believe is that the end of our questions?
Yeah, and a few of the questions that came in were in regards to the article that I had mentioned that we authored in Trust and Estates a couple of years ago. And I sent that link to the individuals that asked privately, but if you go to the Trust and Estates website, which is wealthmanagement.com, I think it's /Trust and Estates or Trust Estates or something like that. Anyways, if you just Google Trust and Estates, you'll find it. It's wealthmanagement.com website. Go to the search bar and just type in quotations, contingent asset class, and the article will pop up. Make sure it's in quotation, so it searches for that specific term, contingent asset class, and the article will pop up.
Okay, great. Thanks, Michael. And thank you, Guy, and thank you, Jennifer, and thank you to Protective Life. This is one of the best webinars that I've been a part of here. So Ashley, why don't you close us out?
Yeah, thank you everyone for attending today's webinar. Once again, thank you to our sponsor for the webinar, Protective Life. Visit their website at finpro.protective.com. You will be receiving an email with the recording of this. And as always, please keep an eye out for the information on the next webinar in this series. Thank you.
Thank you.
Thank you.
Thank you. Bye.
Bye.